You're watching Stock Watch. I'm Zinati Guma, and joining me to unpack your stock-related questions today are Pierre Verster from Protea Capital Management and Ricus Reeders from PSG Hole in Ruimsig. Be sure to send your questions through via email to stockwatch@bdtv.co.za, via SMS on 41392 or on X at Business Day TV using the hashtag StockWatch. All right, Ricus, starting with you, I actually want to talk about the biggest gainers on the JSE today, and that's Pick n Pay and Boxer. And yeah, starting off with the Boxer, they got into the boxing ring and they won. They won the trading session today. What did you make of that performance? And just, I mean, particularly then speaking into the story of the company's investment case on the JSE, of course, seeing that it is one of the new players.
Yeah, I think it was reasonable. Looks as if they're keeping their margins intact and increasing revenue, and that's always nice for this kind of retailer. The share price itself has been recovering. I've maintained that I think it's going to retest this sort of 75 Rand high that they've had over the past year, and it seems to be on its way there. I think that sector in general is also getting a little bit of attention with some of our clothing retailers and even things like ShopRite and Spar picking up over the past few days. That's just on the back of possibly more benign consumer circumstances heading into the Reserve Bank's interest rate decision also in forthcoming inflation data.
And quite interestingly, Pick n Pay actually surged more than Boxer. And JP, is this just the company absorbing that optimism from Boxer? And I mean, or is there more?
I don't know about more. So yes, it's probably the read-through from Boxer. I would just caution on Boxer to say the top line growth was very strong. The margins were very decent. But remember, in the previous period, they use a weighted average number of shares outstanding. So don't get a fright when they do come out with results, not just a sales update. And you see the headline earnings per share actually going backwards. That could very well happen because they will use a full years of shares outstanding rather than a partial period. But notwithstanding that, I think it was a very strong performance by Boxer that benefited Pick n Pay as well. And I'm not sure why Pick n Pay shares went up even a little bit more than Boxer's.
Yeah, very, very interesting. Before we get to the questions, I also want to talk about Kumba Iron Ore because it came out with its interim numbers? And that share price was up about 5%. And Ricus, I mean, the financial metrics were not... didn't really outperform. Revenue was down, headline earnings was flat, but that share still surged. But also noting that they say that the iron ore market was slow, and it seems that iron ore is kind of lagging behind all the other commodities. What did investors take out from this?
Yeah, there's been a bit of recovery, and I think the price went up because at least the operations didn't go backward. As they said in their update before the publication of results, they're getting some better results out of Transnet, which is a huge variable as far as the company is concerned. And iron ore might be lagging. There's a conflict between the Chinese trying to close down their inoperable plants and also giving some support to those that are still working. Plus, the Chinese again trying to jumpstart through increasing production in an environment where they're actually trying to stop that. It's a bit of a mess as far as iron ore is concerned. But be that as it may, if Kumba Iron Ore can get some more traction out of Transnet, then the number 6 months from now could look a lot better as long as the iron price holds.
Okay. JP, your, I guess, view and forecast on the iron ore market. at this point? Because I do also note that counter like even Afrimat, I think, has been trying to recover over some sort of optimism. Your view on that?
Yes, I don't know if I'm the right person to ask about what the iron ore market would do, but I'll give you my stab at it. I do think that while China has been weak now for a while in terms of their property market, that uses a lot of steel in the construction of high-rise buildings, India has been growing nicely, and it's just about getting that balance right as the world transitions from China being the major driver for iron ore demand because of steel demand to India becoming the next big driver for iron ore demand because of their steel demand. So it is a bit of an uncomfortable transition in that regard. And we need it to happen for the iron ore share price to really get a nice uplift. And in the meantime, companies that can weather the storm in this type of environment will do better than their competitors. And I would say that Kumba is one of those because they kept it flat, their profits, which is quite good. And Afrimat is another one. Very good management team. And if they can also do something similar with all the challenges that they've experienced with Transnet and the world iron ore price that has trended down over the last year or so, then investors will like that as well. So it's tough time in the iron ore market, but we've got two very good players in Kumba and Afrimat listed on the JSE.
All right. Well, let's go into banking. What is Nedbank's competitive advantage in relation to the other legacy banks such as Absa, Standard Bank or FirstRand? Where can Nedbank unlock value in the coming years based on its current focus areas or vision? And I do note that, I mean, as much as there's been general optimism on the banking sector, a lot of people have been going to Absa and Nedbank for opportunity. Where's the opportunity there, Ricus?
In Nedbank?
Yeah, bo.
I don't know. I mean, they are so focused locally there. They can probably get better operationally, so can ABSA. I really don't know why I would be picking Nedbank, except if you maybe take a look at fundamental value and say, well, it's oversold. But as far as future growth is concerned, I don't know where Nedbank's going to get that from.
Who would you choose, Ricus, in that complex?
Capitec for growth and Standard Bank for quality.
Okay, interesting. JP, on your side, any views on Nedbank?
So it is smaller than the other banks, which makes it always more difficult to get the scale efficiencies from a cost base. At the same time, the share is also cheaper. It's at the same valuation last time I looked that Absa was on. So those are the two cheapest South African banks. So that could potentially make it more attractive if they can get similar synergies to some of their bigger competitors. And then they've got a very strong position in commercial property. Property has been a tough area the last few years since COVID, but there seems to be some light at the end of the tunnel, so that could benefit Nedbank. And they've got a decent wealth business as well. And especially with the weakening of the rand, people sending money offshore when they want to invest, that has benefited the wealth business. And that business could also do quite nicely. So I do think there's some potential for Nedbank to increase its ROEs. That will increase the justified price to book ratio at which the shares could trade at. And because it is together with Absa the cheapest banking share, there's some opportunity. So at the moment, I like all the banking shares in South Africa. But Nedbank definitely has got a place within those, given its lower valuation and some upside potential as well.
All right. Well, before we go into the break, let's look at property. The first part of the question is I currently hold a position in Vukile. Should I keep on holding? Ricus?
I think it's fine. They're doing well out of the local market, which is difficult, and they're doing very well out of their Iberian interests. So, yeah, I would definitely keep it.
Okay. Well, second part of that question is the viewer says, I've been pondering about Hyprop for a long time now, and I would like to know if Hyprop is still a stock to include in one's portfolio for long-term purposes. Of course, we know what they are currently busy with now, trying to acquire mass. And of course, there is opposition coming from Mass's largest shareholder. Just based on that kind of corporate action, JP, would you be looking at Hyprop?
I would look at them, but they pulled the offer for MAS, so I'd be surprised if anything happens in terms of Hyprop's involvement at MAS. It's very difficult to go up against another shareholder that already has got a commanding position and has put an offer on the table that's very difficult to match. So we'll need to wait and see what happens there. But I think it's very difficult for Hyprop to come back. They'll probably stick with the money that they raised, which decreased their loan to value ratio quite nicely, and recycle that back into some opportunities that Hyprop has. They've got good Eastern European exposure and some high quality South African exposure as well. So yes, I like both Vukile and Hyprop, both South African and European operations, the one Western Europe, the other one Eastern Europe. And like I said earlier, there's some light at the end of the tunnel when it comes to the South African property market. Things have been tough for a few years, but it seems like at this point in time, sure, if we can just get a spark of growth in the economy and a little bit of positive sentiment, then these property companies can really do well from still relatively depressed levels. But we need that to happen. If that doesn't happen, they'll probably just plod along in terms of the South African exposure, and then the European exposure gives you some upside, especially if the rand weakens. So both are decent opportunities, I think.
Okay, yeah, and thank you for making me a little bit more clever today. I didn't know that they pulled out. Ricus, just last before the break, because it seems that the viewers also thinking about, because they've been in Vukile for a long time, I think they may be also thinking about offloading their shares in Vukile and going for Hyprop. Would this be an either or, situation, or would there be space for both counters in one's portfolio?
Well, I think I'll redirect my stock pick a little bit later in this program. But if the person feels that he's overweight in Vukile and he wants to lower the exposure just because of exposure risk, I think there are better propositions than Vukile. If it's just because Vukile has gone up, that's not a good enough reason to sell. I think there's still some gain left in that company, and as I've said at the start, I think it's got pretty good local properties, and it's got a really good overseas portfolio, and I can see no reason to get rid of it right now.
Right, let us get on to weight loss, something that a lot of us will be doing as we head to spring. The question is, who is going to win the weight loss drug war? Novo Nordisk now looking cheap after its fall today, or Eli Lilly with a PE over 60, but a potential weight loss pill in the near future. JP, we know that it fell 26% Novo Nordisk today. But hasn't Eli Lilly also been winning because of Mounjaro?
Yes, correct. So Mounjaro is definitely gaining some market share from Novo's two products. So that's definitely part of the reason. And then the potential of, instead of having an injection, which a lot of people don't like, to have the weight loss pill, which a lot of companies are busy developing. So Eli Lilly is one of them. Zealand is another one. That's a Danish company, and there are a few others. So Novo is trying to also get some exposure to the weight loss pill market by buying their way into that market. But there's definitely a war going on. I can tell you at the moment, it's Eli Lilly that's winning it. And Novo Nordisk have done some very silly things, shot themselves in the foot, forgot to file some patent paperwork in Canada to lose that patent way earlier than what they should have. And it's just, they announced a new CEO today. That's how bad it is. They needed a new CEO. So unfortunately, it's a person, well, as I say, unfortunately, it's a person from inside the business. They might have needed someone from outside to shake things up. But I've been quite disappointed with Novo Nordisk that we have some exposure to. We own the shares, relative to Eli Lilly, which has executed much better than Novo Nordisk. But at the current share price, now again, if we take a 5-year view, if Novo Nordisk can pull up their socks, then it is the better valued of the two shares, but they need to execute. If they don't execute, then I would say you can stay away from Novo Nordisk.
And talking about war, there's a war going on in my own body as well. Now that it's winter, my body just wants to eat everything. So maybe I need those drugs as well. Ricus, is this a sector that is on your radar?
Well, it's I missed the up and I certainly missed the down on Eli Lilly, but yeah, I think it's just in general my problem with the drug companies that they need to keep on getting new drugs. And the moment they've got it, all their competitors go in and rush to do a generic or something similar. So every once in a while they get something which is great, and the share price runs in whatever company got the next best thing, and then the competitors catch up. It's I think that's my problem. It's a huge R&D expense with an uncertain outcome. If they strike gold, if I can put it that way, you can see huge rallies in share prices, or a thing doesn't get approved, and then you see a price fall. Drug companies, the uncertainty surrounding it, the government regulation as far as the pricing is concerned, it's always a sector that bothers me. Again, as I've said, when I go for health companies and that kind of thing, I go for companies that make devices, to keep your bones together or to measure your blood pressure, that kind of thing, which is not subject to the vagaries of what chemical compound you're going to cook up next in your lab.
Yeah, very, very interesting points that you make there, Ricus. Let's go into tech. I have made about 65% profit on some tech shares and was wondering whether the panel would advise me to take profits at this stage or merely leave it where it is and wait for further increases in the shares. I would assume that this is US tech shares. And of course, we know that we have more of the Magnificent 7 earnings coming out tomorrow and on Thursday. I guess then maybe, JP, this then points to the question, what do you expect on the earnings front this week?
Sure. Yeah, big week. So far, the expectations have been exceeded. And it's amazing to see how increasingly every quarter companies engineer an outcome to exceed whatever the expectations, the latest expectations are. So I would guess that, again, we will see most companies exceed expectations in Arctic. And to be more particular, I think also when you talk about tech, one needs to decide which companies you like and which you don't. They are not all the same. You have a company that is involved in social media, Meta mostly, whether it's Instagram or Facebook or WhatsApp. I still like Meta shares. Then you have a company that's in search, Alphabet with Google. I still like Google. Then you have a company that's in electric vehicles and self-driving technology, Tesla. I like them less. Then you have a company that's in devices and cloud services, Apple. I'm lukewarm on Apple. And then you have a company that does cloud services and retail, being Amazon. And I like Amazon, but it's a little bit on the expensive side for me. And those would be my views on the tech shares. So not all the same. So no, I wouldn't just sell a basket of shares just because it has gone up. And that is not a reason to sell anything.
Someone actually said it's not even the Mag 7 anymore, it's the Mag 5. So it really proves your point that not all of them are the same. Ricus, if you'd made that much profit, 65%, would you be holding on and hoping for more upside, or maybe trying to find opportunity somewhere else?
Yeah, it's first of all, what Jean-Pierre said is precisely right. Just because it's got tech in front of the name doesn't mean what it does is follows after the name. There's diverse places where these guys operate. Secondary, I'm at the moment considering the valuations of some of these companies, despite phenomenal growth in both revenues and income. I'm always looking at secondary companies that that use the products that the first tire companies supply in order to make their own operations function better and more profitably. But yeah, just because a thing is up 25% doesn't mean it can't go up further. Follow the momentum on that and make sure that you don't watch it go down and then not do anything. As far as earnings results are concerned, as Pierre said, they will probably beat results. The question is by how much, and will the market be satisfied with that? We've had a couple of companies reporting, IBM, Intel, where it might have been up to expectations, but not good enough. And you see huge price reversals, really, because they are at such dire valuations. So I'd be careful, but I wouldn't sell just because there's a percentage figure that I'm looking at. I'd rather just watch the price very closely.
All right. Before we get to your stock picks, gents, I've got 2 questions on 2 different companies. JP, I'm going to give you Renogen, and Ricus, I'm going to give you Thungela. So, JP, will we have to wait until the end of August to find out the future of Renogen? I thought it was already apparent.
I think there's still a few conditions to be fulfilled before the deal is 100% concluded for Renogen shareholders to swap their Renogen shares for ASP Isotope shares. But I'm not so sure. I'm not following it closely. But yes, as far as I remember, not all conditions have been fulfilled yet.
Okay. All right. And then Thungela. With regards to Thungela Resources, specifically in the coal markets and other miners in general, is price to book a reliable form of measuring deep value, or is it generally misleading based on potential subjective valuations of underlying assets on the balance sheet? Ricus?
For a resource company, price to book is useless because that's not how resource companies are run. It's not a factory, it's a hole in the ground. You have to take a look at what their costs are, what the possible value of their reserves at current prices, and your best guess as to future prices is work out the life of mine and then try and guess something from that. So I wouldn't use price to book as far as the mining company is concerned. Thungela itself, thermal coal, we were talking about the iron market. There's really nothing going on sorry, not the iron market, that's thermal coal. Coal price itself is depressed, and we're not really seeing anything in the share price. That picks up, Transnet gets its act together. It might flow through into Thungela's bottom line, but no real indication for me at the moment.
All right. Well, gents, let us get to your stock picks for today. JP, what are you choosing?
Zanati, I'm choosing a special situation, a corporate action opportunity. Adcock Ingram. So last week, Natco Pharma announced an offer, a firm offer to buy Adcock Ingram shares at 75 Rand a share, and the company will then delist. And when you have a corporate action like this, a special situation, you have 2 big questions to answer. Number 1 is, what is the probability that you will get this amount of money that's being offered? And number 2 is, how long will you need to wait before you get the money? Now, on the probability of the deal being done, I think it's a very high probability because they're not buying control. They're just buying 35-odd%. And that means it does need to go to the Competition Commission. It's not regulated by the JSE. It's only a takeover regulation transaction. So my expectation is in the next 3 months, 4 months maximum, definitely before the end of the year, it will be wrapped up and you will have your 75 Rand. And you might get a dividend. Because, again, because it's a minority buying in, it's not as if Bidvest are going to stop Adcock from declaring dividends. So hopefully we can squeeze out one more dividend before Adcock Ingram delists. And then on the timing, like I said, 3 months, 4 months maximum. So between your 75, maybe a little bit extra, and 3 months to go, you get a very good annualized return if you buy the shares at 69 Rand, or let's say under 70 Rand. So that's why Adcock Ingram is my pick tonight.
All right. Ricus, what are you hanging your hat on today?
We're talking about public companies, and stock pick is locally listed. It's Sirius. but not a local property company. They've got some operations in the UK, but most in Germany. Extraordinarily well run, decent set of results uh, recently, and I think with Europe, there's growth potential, not necessarily because the companies are going to start exporting madly and things like that, but I mean domestic European growth, and specifically Germany, on the back um, of just state funding for private enterprise, led by weapons manufacturers. And let's face it, if you believe that the US tech sector is going to do well, by default, you must believe Europe is going to do well, because guess who's going to buy all the US services? So in that respect, Sirius is very well placed. As I said, first of all, management-wise, and also the type of property that they are concentrating in, which is industrial, light industrial type of operations.
Awesome. Thank you so much for your time and for your analysis today, gents. Really, really appreciate it. That is all for tonight's Stock Watch. Thanks to our guest, Pierre Verster from Protea Capital Management and Ricus Reeders from PSG Hole in Ruimsig. Up next, The Close. Stay watching.